Hello, guys, and welcome to our lesson number 6, the business entity types. Business entity types. As usual, you're with me, Goodson's Charlie, your online tutor. Now we continue with our series of lessons on Introduction to Accounting, and today's topic is business entity types. We want to talk about the business entity. So this is what we're going to cover under this topic. We'll discuss the fundamental principles, the principle of business entity concept, which was already, of course, discussed in brief in our previous lesson. We are going to explore this further, and in fact, this whole lesson is based on this concept. We'll also discuss why this separation is crucial, the importance of separating business activities from personal ones, and then we'll also look at the types of business entities, which include sole proprietorship, partnership, limited liability company, and corporations. And then at the end, we'll also look at the key takeaways from the whole of this topic. So please stay with me. Okay. Now, the business entity concept. In lesson number 5, we talked about this concept. So this is more like a recap. So a foundational accounting principle that states that a business enterprise is an accounting entity separate and distinct from its owners. This concept recognizes any business as a persona on its own. So the golden rule under this concept, as we indicated earlier on, is that the business transactions must never be mixed with the owner's personal transactions. Okay. So the business has its own personal, its own financial persona and its own bank account. So we don't have to mix it with our personal business. Why is the business entity concept important? Why does it matter? Okay, so this concept helps us with accurate reporting. It ensures that financial statements, that is income statement and balance sheet, truly reflect the business performance and not the personal business of the owner or the one who is running the business. Okay. It also aids with informed decisions in that it provides clarity for managers and investors who make sound decisions based on the business health and not the owner's vacation spending and other business, personal related spending. Above all, it also has legal and tax compliance implications in that it is essential for calculating correct business tax liabilities, adhering to legal reporting standards. As a person, you can also have your own, you can also be preparing your own tax returns. But as a business, we want to see the true implications for tax. So for auditing, it also makes final records clean and auditable, increasing credibility. So that is why separating personal matters from business matters is very important. So moving on, let's now look at the types of business entity. So number 1 is the sole proprietorship. This is a very famous one, as the word itself suggests. Sole means just one person. So this is a business entity that is owned and run by one individual. That's hence the name sole proprietorship. So the key feature is that there's no legal distinction between owner and business, and there is also unlimited liability. So the owner is personally responsible for all business debts. So unlike other types that we're going to look at, the sole proprietorship, you cannot separate personal transaction from the business transaction. However, on accounting note, we remember the concept, even though legally linked, accounting still treats them separately. We don't mix transaction of the business as those and those of personal in nature. So on accounting, regardless of the legal status of the of the business entity, we still treat them separately, hence recognizing the famous concept of substance over form. Okay, and then type number 2 is partnership. So this is a business structure involving 2 or more owners who agree to share profits or losses resulting from the business transactions. So it's basically governed by a partnership agreement. So 2 or more individuals agree to set up a business, and they also agree the nature in which they will be sharing the profits and the ratios and the like. So in terms of liability, typically unlimited liability for general partners. So the partner's personal business is not legally separate from the business transactions. So they can be sued for debts of the business because there is no limited liability. But however, there are some variations. There's limited liability partnership. They offer some protection depending on the agreements and its legal status. However, for the sake of accounting, we also still don't separate them. We separate them. We don't mix the two transactions. We recognize substance over form. So another type is a limited liability company. So this one is a hybrid structure combining the features of corporations and sole proprietorships and partnerships. So the key benefit is that it provides limited liability protection for owners or members. That is to say, the owners are not personally liable for the business debts. So it has a personal financial status as a business. In terms of taxation, it offers a flexible pass-through taxation. That is to say, profits or losses pass through to the owners or personal tax returns. So the taxman will not separate the two. Okay, we also have another type, the corporation. So this one is now a separate legal entity distinct from its owners or shareholders. So the key feature is that it can enter contracts, own property, sue and be sued in its own name as a business, separate from its owners or its shareholders. The shareholders are not personally liable for the obligation of a corporation, hence the liability. So this one has a limited liability for shareholders. Personal assets are generally safe from business debts. So this is the type of entity that is in full compliance with the business entity concept. For example, a public traded companies. I've given examples here of Apple and Amazon, some of the famous worldwide publicly listed companies and private corporations. So those ones, for example, Amazon, the main shareholder is what do we call this guy? Jeff Bezos is not personally liable for the uh, debts of Amazon. So I've prepared a summarized comparison table of all the types of business entities, sole proprietorships, partnership, limited liability company, and corporation. So the key features are the ownership, liability, and legal status and taxation. So it's just a summary of what we have already talked about in terms of partnership. In terms of ownership, sole proprietorship is only one individual owner. And the partnership, it can be two or more guys agreeing to share profits in whatever agreed way that they will agree. Limited liability company, it can be one plus other members, and it also offers a certain level of limited liability. And for corporation, it is also one or plus as many as possible number of shareholders. In terms of liability, the sole proprietorship, we said it has unlimited liability in that the legal owner is not cannot be shielded from the debts of the business, can be sued on behalf of the business. And patentship, we have also unlimited generally, where so in terms of liability, sole proprietorship and partnership will have unlimited liability, where the owners are also personally liable for the debts of their business. As for the limited liability company, it's limited, just like corporations, where the owners or the shareholders are not personally liable for the debts of the business. In terms of legal status, sole proprietorship and partnership, the legal status is the same as the owner, while limited liability company and corporation, they have separate legal status, whereby the business is also an individual on its own, in that it owns, sues, and transacts business separate from the owners. In terms of taxation, so we say sole proprietorship and partnership, there is a pass-through where profits and losses reported on owners' personal tax return, while limited liability company has partial pass-through where some can be separated, and for corporation, is a separate entity where the personal tax returns are separate from those of the business entity. Okay, we move. Now, the key distinctions is limited liability, liability protection, taxation, and formalities. So we have already explained this, where I said liability protection, the key differentiating factor is liability. The sole proprietorship and the general partnership offer no protection for the owner's personal assets from business debts and lawsuits. Corporations provide the legal shield, limiting owner liability to their investment in the company. As for taxation, the sole proprietorship and partnership have pass-through taxation, avoiding separate business tax filings, while corporations are taxed separate as separate entities, which can lead to double taxation, taxed at the corporate level, and again, when profits are distributed, the dividends to the owners will also be taxed as at personal level. That could be one of the disadvantages, while for the other ones, this is the same. In terms of formalities, corporations require significant record keeping, annual meetings, and adherence to regulatory requirements because of the nature. Okay. Okay. So what are the key takeaways here? So we're saying the business entity concept is the backbone of reliable financial reporting. We have to choose the right entity type based on liability and tax needs, as we have discussed. And we also have to always maintain separate bank accounts and meticulous records for the business only. So that marks the end of our discussion today. I hope you enjoyed. If you have not listened properly, you can always play back the video. Thank you for your attention and watch out for our next lesson. Thank you and goodbye.